Australia is in the grips of a well-documented housing crisis as home prices continue to climb with demand still outstripping supply. The latest data from property consultancy CoreLogic showing the imbalance driving prices higher across capital cities.
This isn't a warning about the future. It's a snapshot of what's already happening. Across New South Wales, tens of thousands of families are missing mortgage payments, burning through savings, and quietly entering hardship arrangements. Interest rates didn't just rise. They reset the rules of home ownership overnight. What's coming next won't hit NSW evenly. Some cities will struggle. Others will break first. Forced sales, mortgage defaults, distressed listings spreading street by street. By 2026, economists warn that the suburbs already under pressure could face a full mortgage fallout. Not because people were reckless, but because they borrowed in an era that no longer exists. If you live in NSW, if you own property, if you're paying a mortgage, these are the 10 NSW cities where the mortgage crisis is already unfolding and where the damage will accelerate first. Number 1, Campbelltown, the epicenter of mortgage stress. Campbelltown is ground zero of NSW's mortgage crisis. More than 10,500 households in a single postcode are currently struggling to meet repayments, one of the highest concentrations of mortgage stress in the country. Arrears rates in southwest Sydney hover around 3.5%, meaning roughly 1 in every 28 households is already falling behind. That's nearly triple the national average. The core issue is leverage. Many buyers entered the market between 2020 and 2022, using 5 to 10% deposits, borrowing at the very edge of serviceability when interest rates were near zero. Median house prices pushed toward $930,000, far outpacing income growth. When rates surged, repayments didn't just rise. They consumed nearly half of household income for many families. That leaves no margin for error. Employment risk worsens the problem. Campbelltown has a high concentration of construction, logistics, and trade-based jobs, industries that weaken quickly during economic slowdowns. Distressed sales are rising quietly, even while headline prices appear stable. This is what early-stage collapse looks like. Stress first, price falls later. Campbelltown is not an anomaly, it's the preview. Number 2, Liverpool and Chipping Norton. Growth hiding fragility. Liverpool looks strong on the surface. Billions in infrastructure, rising prices, rapid development. But underneath, it's one of the most over-leveraged housing markets in NSW. Arrears rates exceed 3.1%, ranking Liverpool second nationally for mortgage stress. Between 7,700 and 10,000 households are already under pressure. Median house prices pushed past $1.2 million. But owner occupancy sits at just 35% and falling. That's a red flag. It means a growing share of properties are owned by investors facing higher rates and shrinking yields. Days on market are lengthening, signaling demand fatigue. The population is young, heavily indebted, and stretched across childcare, rising living costs, and mortgage repayments. Infrastructure doesn't fix this problem. Incomes do. And income growth hasn't kept up. Liverpool shows how price growth can disguise structural weakness until stress becomes unavoidable. Number 3, Abbotsbury, half your income to the bank. Abbotsbury records Sydney's highest mortgage arrears rate, sitting above 3.5%. But the real danger lies in cash flow. Here, nearly 50% of household income goes to mortgage repayments. Median house prices sit around $1.5 million, while median monthly household income is roughly $4,400. Mortgage payments alone exceed $2,200 per month. That leaves almost nothing for life. Savings buffers built during the pandemic are gone. Distressed sales across Sydney's southwest have surged, with 1 in 10 transactions now classified as distressed. Abbotsbury shows what happens when high prices meet low buffers. Stress becomes permanent. Number 4, Casula, the first home buyer trap. Casula is a textbook example of the first home buyer trap. Many buyers entered with minimal deposits under government-backed schemes, leaving almost no equity buffer. When rates normalized, repayments surged instantly. Arrears approach 3.5%, among the worst in NSW. High loan-to-value ratios mean even small price declines push households into negative equity. With limited refinancing options and vulnerable employment profiles, forced sales are increasing. Casula proves that accessibility is not affordability. Number 5, Mount Druitt and Lethbridge Park. No escape routes. These suburbs face the most dangerous combination: mortgage stress and rental stress at the same time. Lower incomes, high leverage, and insecure employment mean households here have no fallback options. Selling doesn't help. Rents are just as unaffordable. Once savings are exhausted, defaults follow quickly. This is where housing stress becomes a social crisis, not just a financial one. Number 6. Byron Bay, a 30% price collapse. Byron Bay's crisis is about wealth destruction. Prices have fallen roughly 30% from their peak, wiping out massive equity. Investors and tree changers who borrowed aggressively are now trapped in negative equity with falling rental returns. Listings are rising, days on market are long, and sentiment has turned sharply negative. This isn't a pause, it's a hard reset. Number 7. Lismore and Northern Rivers, uninsurable mortgages. Floods destroyed homes. Insurance destroyed affordability. Premiums now range from $12,000 to $20,000 per year, with some insurers withdrawing entirely. Without insurance, mortgages become toxic. Thousands remain displaced. Property values are down 25-30%. Buybacks cover only a fraction of affected homes. Here, housing stress has become a humanitarian crisis. Number 8. Central Coast, Sydney debt, regional wages. Sydney buyers pushed Central Coast prices toward $930,000. But local wages never followed. Arrears rates place multiple postcodes in the national top 10. Rental stress exceeds 90% in some areas. Migration has turned negative. What once looked like an escape has become a pressure cooker. Number 9. Bidwell and Currans Hill. Maximum leverage, minimum buffer. These suburbs rank among the worst nationally for delinquency. First home buyers entered at peak prices with minimal deposits and low incomes. Refinancing is no longer possible. Distressed listings are rising quietly. This is the end stage of overleverage. Number 10. Blue Mountains, metro prices, regional pay. The Blue Mountains combine Sydney-level prices with regional wages. Arrears exceed 2%, a critical warning threshold. Rising insurance, commuting costs, and limited downsizing options trap households in prolonged stress. This won't collapse suddenly. It will grind downward. These 10 NSW cities are not outliers. They are early indicators. As 2026 approaches, mortgage stress will not spread evenly. It will cascade from these pressure points outward. Understanding where the cracks are forming is the difference between preparation and surprise.